You need to read the chart the same way you read a book, candle by candle. Once you understand how to read each candle in context, the market starts telling you its story. In this video, I'll show you exactly how to read a chart like smart money traders do. For example, the market has just broken above this level, and the overall market structure is bullish. But that doesn't mean we should enter immediately after the breakout. Trading every breakout without confirmation is one of the biggest mistakes traders make. Instead, we wait for a retest. Now here's something interesting. Instead of retesting the breakout level, the market breaks below the most recent swing. Let me ask you a question. Has the market formed a change of character, CHoCH? Has the bullish trend ended? Most traders would say yes, because they believe that breaking the latest swing automatically means the trend has reversed. But according to the smart money concept, this is not a valid swing. Let's apply the Fibonacci tool from this swing low to this swing high. Notice that the pullback never reached the 40% Fibonacci level. That means this is not a valid swing, so the break of this level does not confirm a trend reversal or a change of character. As a result, the market can still continue higher toward the last order block. Above that order block, we also have a fair value gap, creating a high probability area of interest. Finally, the market prints a strong bullish confirmation candle, giving us the confirmation signal for a potential long trade. When the market tapped this order block, we didn't jump into the trade right away. Instead, we waited for a rejection candle. Once a strong bullish confirmation candle appeared, we had our entry signal and entered a buy trade. Our target was placed near this resistance level, while the stop loss was set just below this zone. Next, the market broke above the previous higher high. Now let me ask you a question. Where do you think the market is most likely to go from here? To answer that, we'll use the liquidity concept. Whenever the market is in an uptrend and starts targeting the external range liquidity above a higher high, there's a strong possibility that price will continue moving upward. That's why we'll take 50% profit at this level and let the remaining 50% run by trailing our stop loss. After a small pullback, the market continued higher, giving us another opportunity to lock in profits around this area. This trade delivered an excellent risk-to-reward ratio of nearly 1/6, which is exactly what professional traders look for. The market then pulled back again and broke above the previous high, giving us a break of structure, aid. But shortly after that, price broke below this swing. Now let me ask you another question. Has the market formed a change of character, CHoCH? The answer is no. This wasn't a valid break of structure because it wasn't based on a valid swing. If we apply the Fibonacci tool from this swing low to this swing high, you'll notice the pullback never reached the 40% Fibonacci level. Since this isn't a valid swing, this is not a valid change of character either. Even though the market drops sharply afterward, the overall market structure remains bullish. That means we're only looking for buying opportunities. Finally, as price reaches this order block, we get another strong bullish confirmation candle. Notice something important here. The market has just targeted liquidity at this level. Buy-side liquidity has been collected and a liquidity sweep has taken place. But remember, whenever the market targets liquidity, two things can happen. It can either perform a liquidity sweep and reverse, or continue with a liquidity run. So what is more likely here? A liquidity sweep has the higher probability. Why? Because the market first targeted the internal range liquidity. When internal liquidity is taken first, smart money often uses an important level to perform a liquidity sweep before continuing in the original trend. This gives us another high probability buy setup. We'll place our target at the external range liquidity above, set our stop loss just below this level, and once again, this trade offers an outstanding 1/6 risk-to-reward ratio. As you can see, the target was eventually reached. This is how you should read a chart, candle by candle. Every piece of price action tells part of the market's story. The more details you include in your analysis, the better your chart reading skills will become. Let me show you another example. The market has just formed a break of structure, and this pullback retraces to the 50% Fibonacci level, which means this swing is considered valid. Next, price moves sideways for a while, and eventually we see a downside breakout from the range. At the same time, this bullish trend line also breaks down. Now here's the question, should we enter a sell trade? The answer is no. We should never sell here because the overall market structure is still bullish. As long as the market doesn't break below this valid swing low, the bullish trend remains intact. Price continues moving lower, and we can identify an order block here. Right above it, we also have a fair value gap, FVG. The market retraces perfectly into that fair value gap and prints a strong bullish confirmation candle. That gives us a high probability long setup. We'll place our stop loss just below the fair value gap and set our target at the previous higher high, where the external liquidity is resting. The market rallies strongly and reaches our target. Now the market breaks above the previous higher high, creating another break of structure. We'll connect these two swing points and apply the Fibonacci tool. As you can see, the pullback is healthy, which confirms that this is a valid break of structure and a valid swing. At this point, we update our most recent swing. Instead of using the old swing, this new one becomes our reference for future market structure. Next, price starts moving lower. An order block forms here, along with a fair value gap. However, this fair value gap has already been mitigated, so it no longer provides a valid trading opportunity. That's why we won't take an entry from this FVG. Then the market breaks below the last valid swing. Now let me ask you another question. Has the market formed a change of character, CHoCH? The answer is yes. This is a valid change of character, which means we should now focus only on sell-side opportunities. Remember, market structure should always be your highest priority. Price pulls back, and then we get a strong bearish confirmation candle. This area is also acting as a breaker block. As soon as price rejects the breaker block with bearish confirmation, we can enter a short trade. We'll take 50% profit near this support level and trail the remaining position as the market continues lower. The market drops sharply from the breaker block, giving us a 1-4 risk to reward trade, and our target is successfully achieved. This is exactly how you should read a chart, one candle at a time. Every candle provides valuable information. Before making any trading decision, analyze every element carefully and always follow proper risk management. Before I end this video, here are a few important rules for successful chart reading. First, always mark the previous day's high and low before starting your analysis. Second, begin your analysis on the higher time frame. Identify the overall market structure first, then move to the lower time frame and only trade in the direction of that higher time frame trend. Third, never rush your analysis. Most traders lose because they make decisions too quickly. Instead, study every detail on the chart. Ask yourself what price is telling you, what buyers are doing, what sellers are doing, and where liquidity is located. Only after answering those questions should you enter a trade. If you learn to analyze the market this way, you'll be on your way to becoming a consistently profitable trader. If you found this video valuable, don't forget to hit the like button and support the channel.